What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is August 1st of 2022. Well, folks, I hope you all are having a great start to your month wherever you are, and what better way to kick off the month than with a Macro Monday here on the DataDash channel. We're going to be talking about the continued relief rally we've been seeing in Bitcoin, where we think things are heading next, but on top of that, we're going to be diving into the broader macro environment, looking at Ethereum, altcoins, the whole shebang, and really trying to figure out when we could start to see some weakening signs in this relief rally. Is it something that's going to come soon or much later down the line? We've got a lot of things to dive into in today's video right after our quick sponsor. And our sponsor for today's episode is Ember Fund. In light of the recent events with centralized finance platforms, it's more imperative now than ever to have complete control over your own cryptocurrencies. And when you take control of your crypto through self-custody and decentralized finance, or DeFi, it allows you not only to have full transparency about where your funds are, but allows you to withdraw at any time. But the problem has to do with the user experience, and that is where Ember Fund comes in. Ember Fund stays true to the original principles of crypto and DeFi, allowing you to verify your transactions on-chain, while at the same time having the same smooth user experience you're used to on most traditional exchange platforms. Let me go ahead and show you how it works. You can invest as little as $10 and pay zero gas fees on transactions. Plus, you can fund your wallet via Apple Pay, credit card, or transfer from Coinbase. Along with that as well, you can choose a number of different portfolios, from the Originals portfolio, which gives you rebalanced exposure to Bitcoin and Ethereum, fee-free and tax-free, as well as the top NFT index made of blue chip NFTs like the Bored Apes, CryptoPunks, Doodles, and World of Women, allowing you to participate in the upside of NFTs with as little as $10. And on top of that as well, they've got the Metaverse Index, which gives you a broad exposure to the metaverse through coins like Illuvium, Decentraland, Axie Infinity, and Audius. And if you're looking to play it safe, you can always try out the BTC Defense portfolio, which uses an algorithm in order to trade in and out of Bitcoin. It works well during bear markets, and year to date, it's only down 8% compared to 31%. With just one tap, you can invest in a portfolio and gain market exposure to the leading cryptocurrencies. And as mentioned before, I can verify this transaction on the Ember Fund app or go to Etherscan and verify, meaning I can withdraw my assets at any time. I'll check back on my investment in a couple months and let you guys know how it's going. But if you're interested in checking out the Ember Fund app, check out the link down below in the description and receive a 30,000 Satoshi airdrop when you invest as little as $100 using my access code DASH2022. Alrighty, everyone, so let's go ahead and kick off the conversation. We've got a lot of interesting topics to dive into. We're going to be talking about Bitcoin's next move, Ethereum and altcoins continuing to remain strong, and our outlook on equities, which remains bullish. And this has all been followed by a continued cooldown in commodities, providing the cushion for assets to continue moving higher as people believe the Fed will have higher control over inflation. And again, the big point I want to focus on here is just simply following what price is saying. I think sometimes traders and investors try to go against what the market is saying, trying to catch the next wave too early, and it can sometimes lead you in a really bad position. Okay, so let's go ahead and kick off the charts here. Now, when we're taking a look here at Bitcoin's price action, what I think we're going through is what we've been going through for the past couple of months. Every time we seem to make some push towards higher highs here within price, or in a kind of comparative range of resistance like we did back on the 26th of June and here on July 8th of 2022 around the $22,000 range, I think we're doing exactly here. We're going to probably have a couple more days of downward slow moves in price here. And there's a reason why we're looking for these higher support ranges. It's not only to showcase the psychology of the market through a trend reversal of higher lows and higher highs. That's indicative of an upward trend, or at least the beginning of an upward trend, which is good news. But on top of that as well, it showcases here the selling and buy side dynamics of the market that makes and defines a relief rally in many ways. We can see that as time progresses here, the buy side candles are overwhelming any of the sell side candle days. When the market gets moving, people rush in. And when it gets to these heightened ranges here, there are some sellers in the market. But the important thing is that as people are profit taking here, things don't fall down as fast as they come up. And it tends to be that there are people getting their bids filled that, again, is helping to wane against that sell side pressure before the next wave of market buy orders come in. And we'll take a look at Bookmap in a little bit, one of our partner tools, to help try to understand this. But if you guys are really eager to learn a little bit more about what we think, why we think this is a relief rally, more specifically, and how we believe that we're going to be just probably forming in a higher low here at one of these ranges, and then eventually whipsawing higher here and heading up towards 27,500, 30,000, you name it, one of those big even target ranges that's going to give us a good way to recoup on some of the losses if we've been holding positions, or even benefit and make some short-term trades on this relief rally. I definitely recommend you guys check out this month's recent edition of the Dash Report. It's our big article that we wrote about in regards to the crypto and equity markets. And it's important to understand here that as we move up higher, to not get caught in the psychological trap of a relief rally, to not get caught up in the euphoria and the overt optimism that comes in post being absolutely fearful. This is exactly the kind of trap that can wreck not only the bulls, but also the bears as well. So we're going to be talking about that mentality and also the signs as we look throughout history to spot bear market bottoms, real consolidation before we kick off the next rally versus just a mere relief rally in price, which we get many of through our traditional crypto bear markets. So I definitely recommend you guys check that out down below in the description. There's a link. You guys can get a 20% discount for an annual subscription. But I digress here. You guys know it. I'm going to be candid with you guys here on the channel. I think we are moving higher here. I definitely recommend you guys can check it out if you have the time and the ability to, where we dive into why our reasoning is here for this even further as we take a look throughout history. But price action itself is also just incredibly telling here. Take a look at Ethereum in regards to price. When we, for example, had multiple days of stagnation, practically an entire week here of price action, of sideways price, after a 10% downward move for Ethereum and a continuation the next day after, we ended up taking that secondary daily candle, not even coming close down here towards the accumulation or consolidation channel here, and in fact had a golden hammer here on July 26th, around $1,400, and pushed right back up to $1,800. And look at that, after these kind of moves here, even though we're not blowing very, very high into the stratosphere here, essentially with price, right? We're not just going absolutely vertical. When we have these kind of consolidated phases here, right? It's not, basically extensive profit taking here. We see that price is kind of pushed sideways. And this is very telling of the fact that a lot of people who have wanted to get out of the market have gotten out, essentially. And on top of that as well, there are still people who are profit taking, who are taking advantage of this relief rally. But when we see price only pushing slightly downward, this is telling that there is likely more room to go in the relief rally. And it has to do with how institutions enter into the market. And this is where we got to dive in to Bookmap. So when we dive into the Bookmap profile here, taking a look at the market metrics, it might seem a bit overwhelming, but stick with me here. It's going to prove to be very valuable in understanding where things are heading here. When we take a look at Bookmap, we can see through these volume dots over price and through the cumulative volume delta, CVD, that market order flow is moving higher here for Bitcoin. And in fact, even during these capitulative periods, market order flow is still holding relatively high here. But there's a little bit of a difference here when we take a look at Ethereum's. All right, when we take a look at Ethereum's chart here, we can see that market order flow has remained quite negative here. Much different volume profile than that of Bitcoin over the exact same time frame. So what's going on here? What's the big differentiating factor here between Ethereum and Bitcoin? Well, the important thing to understand here is that if someone is market selling into the order book, that means there's got to be bids to be able to pick up those orders. And if we take a look at the combined order book here, the aggregate order book, we can see why this is the case. Even though people are profit taking on Ethereum, as these prices go higher, there are bids on the order book taking advantage of that sell side pressure. Institutions essentially buying in at those price ranges or lower price ranges from the kind of euphoric highs of the rally, essentially getting in a position for the next leg up. They're observing how price is reacting here. And they know that as there's a lot of liquidity on the sidelines, you either are going to get your bids filled, or when there's enough market order flow pressure that it's going to start moving up quickly, because there's still a lot of people who are short the market here that are going to get forced out of their positions. And that's the key lesson to learn from here. We need to understand how institutions are playing this. They're not market order buying here and to price too much. They're rather waiting after these pullbacks to get in their bids filled and ride the wave higher. They have a lot of excess liquidity right now. They're going to take advantage of it, but they're only going to do it in the way that best benefits them. They don't want to face a lot of market spread. They have the patience and time to do trades over a multitude of days, weeks, or months, and they're going to make sure that they get their bids filled at a fair price, not incurring rapid rates of slippage. And they wait for, again, the market order flow, the retail buyers essentially drive up price, the shorts to get liquidated, and lead us up towards that $27,500 target to $30,000, right? That's the name of the game here. And that is a big reason why price is playing out how it is. So we think that Ethereum will likely come down into this range, might even break a little bit below here. But either way, it's going to start to hold up and continue that move here as we go into the month of August. Again, don't take my drawing as gospel. It's just used for illustration purposes to kind of understand where things might go here. And we can see that through the ETH to BTC ratio here. Even though it's looking a little bit exhausted, starting to teeter a little bit here with a line of support here on the RSI, it is still important to realize that Ethereum's holding up well here. And another thing as well, when we take a look at the altcoin market, as we, again, just kind of drew as an outline here back over the past few weeks, back here in late June, we talked about how altcoins would start to charter up back towards their previous relative highs here from the 24th of June. And we are continuing to do that here. It looks like we're going to break out here towards the 0.7 range here, essentially, back to where we were back during May of 2022. So I think that there's a good chance we continue here. And again, the important thing though is to not get excessively greedy. Don't go on taking massive altcoin positions here, or even for that matter, dollar cost averaging. This is an area where you make trades where you get in and you get out quick. You have no love for your positions. You have no commitment to it. I know it sounds a bit dark and cruel, but the fact of the matter is that this is not a period of time to take on excessive risk. It's a period of time where you can take long positions, you can ride the wave, but know that it's a wave, and eventually it will likely pull back or crash, essentially. We are essentially going to see this cool off once again here, as we are in a long-term risk-off market. And I think this also, again, leads us into the conversation around equity markets. What's the game plan here? Well, I don't know exactly how this week will play out here. We're up at a price range here that had faced some resistance back here in May. And I think one of the most important things we could do here, rather than just blowing up vertically up to this price range, kind of like what we did back between March of 2022, what I think would be very important to get us to the final stages of the relief rally at our target price range at 13,500 would be to be coming down here over the next day or two, making this range support and bouncing off heavily from it and leading up towards our target range here in mid-August. I think that that is likely how things are going to play out. Again, it's just a rough sketch, nothing too pertinent or absolutely certain. I'm not no Nostradamus here, but I just want to, again, give that guidance or outline as to how things can play out. Things don't move in an absolute straight line, and we shouldn't let any slight decline scare us or spook us here. We've got clear higher lows and higher highs, a very strong trend coming out of the lows back here on June 16th. At around 11,000 points in the NASDAQ. We are currently right under 13,000. We've had a nice steady room of gains, and we've made some really great trades here during this period of time. We've been able to recoup a lot of losses on crypto positions that we've been holding through here. Again, not getting caught 2 steps behind, waiting for those gains to come up. And boy, did it pay off to just be patient. Some of our altcoin positions got back to where they were back during November and October, back in 2021, when they were at some of their best levels against Bitcoin. And their dollar value was, well, because of that, recouped to levels that we hadn't seen in months. So it was definitely worth it to just hold through, wait for it, stay strong, and get back up to that price range for a lot of those plays. And also, we've also made some equity trades here, like our trade on ARK back last, I think about 2 weeks ago. We made some really great returns in ARK. And the reason why we're continuing to remain confident here is we got the RSI cross back here in June. And since then, every time the RSI has been coming down here on the daily, we got buyers coming in. They're driving up price. And it's a very similar pattern. Notice here to what we saw in equity markets that we're also seeing in crypto, right? That the buy side pressure is setting those higher lows or consistent resistance ranges, and those higher lows here signifying the price is ready to move higher. And the reason for all this has to do with what we're seeing in commodity markets. We know that the Fed's central objective is to cool inflation, and it is going to adjust monetary policy tools like interest rates or quantitative easing and quantitative tightening, depending on what we see within commodities. Now, I want to start off here by looking at the two big commodities that were driving inflation, and that is, of course, oil and natural gas. Oil here, I know a lot of people, focus on the minute movements here, like within price, and some are like, oh my God, oil went up 5% today, the market's going to collapse. That's not how it works. What we need to look for here, and what the Federal Reserve is watching, is what's the longer term trend here. They're not looking at the daily time frame. They're looking here at the weekly trend. And take a look, sorry, we got to get off the log because of the crazy flash crash for oil back in April 2020. But take a look here at oil's weekly performance. I don't know about you guys, that does not look bullish to me. Now, I'm of the opinion that in the coming months, we are going to see oil probably tick back up, because if the Federal Reserve starts to cool down on its objective of raising interest rates and reducing the balance sheet and unfortunately putting the economy to a recession, if it doesn't do that, if it doesn't put us into a recession and doesn't cool down demand, the demand is going to churn right back up as fast as supply is growing. And that's going to lead oil to whipsaw back up. But again, we're talking about the near term, the relief rally here. We expect oil is going to continue rolling over. Look at this price action. We broke through a wedge that could have been the foundation for further moves here for oil, but unfortunately wasn't. And this is usually where in the past, oil has moved lower here. So we expect that it will probably come down here towards around 80 bucks a barrel. And that's going to give the Fed all the confidence it needs to start lowering its objective increases in interest rates per each FOMC meeting. So that's what we're looking for here. The signs that the Fed is going to rely on to feel that they have been able to tame inflation. Take a look here at natural gas, right? I've seen some people again go, oh my gosh, natural gas came back up, this and that. How can you not be, how can you be so bullish, right? Look at that. Clear. I think I forget my candle patterns here right now, but essentially a clear bearish sign here, essentially. All right, we can clearly see that all the gains here from this past week in natural gas, right? We went up from 8.3 here on the CVD all the way up here towards 9.4. And now we're rolling back down here. A clear double top here. The momentum of higher lows and higher highs is starting to wane here. And these dip buyers are likely going to get caught in a position where they're going to be forced to eventually sell here if we break through this channel. Now again, I do believe, like oil, we'll find support here, maybe around 4.5. We did this actually back in the past. If we look back at the previous cycle rallies, right, we came up here towards around 10 and we made support around 4.75 to 5 here, but a 50% pullback. And we continued to hold there for a while. We had similar lows, higher highs, and then we had the final breakout there on $15 to $16 for natural gas. We could get something very similar to that. But for now, we got to look at what price is telling us. We're going to continue to build on that point as we go throughout the conversation. But a few more commodities here. This isn't just the energy-based commodities. It is also industrial commodities and consumer commodities. Take a look at lumber here. Lumber not only peaked way back in May of 2021, getting my years wrong, but we also had a significant lower high here in March of 2022 and have continued to roll over extensively on the monthly chart, looking like we're going to be breaking that previous line of ascending support, probably down here into the $300 range, due to the fact that supply for homes on the market is starting to expand. People are looking to sell their properties, and there are not many people taking mortgages out right now due to the high mortgage rates. Take a look at copper futures, right? Got a little bit of a rebound here towards the close of July, loosening a lot of the losses, but it looks like we might just roll over yet again and bring down a lot of those losses here in the month of August. The trend is very clear here. We had a clear double top here at the highest range we'd seen in history for copper's price. Let's take a look at wheat futures. Yet again, wheat is one of the great commodities you can take a look at to find cyclical tops in commodities. And we can see yet again, just like we did back here in 2008, a rollover here for wheat. And again, we might get some secondary wave. Who knows? It's not to say that something like that couldn't happen, but we are clearly seeing demand on the global stage here due to the expensive cost of dollars in the global economy, the supply shortage of dollars, basically leading demand and consumer confidence to record lows. And that is exactly the intent that the Fed has to cool inflation. The only thing it can do is try to force not only the United States, but other global economies to cut back on consumption in order for demand to cool down and supply to be able to get back towards a point of equilibrium that leads to healthier prices and a lack of inflation in the economy. I think the Fed is going to jump the gun on assuming that they have control of that in the coming weeks and months into the next few FOMC meetings. But again, this is why we believe we're in a relief rally versus in a sustained long-term rally in the market. Taking a look here at Apple, though, I want to go ahead and use this as an example for this topic of listening to price. Now, a lot of what we talked about today in the video is all about listening to price. When it comes to Bitcoin, when it comes to Ethereum, until we see signs of weakness, within a given asset or commodity, whatever it might be, we need to trust that the market is in the know here. It is leading forward. It is going to tell us a lot about where things are going to go. We just have to learn to listen for it and not care so much about every single indicator or this one magical thing. The fact of the matter is the best thing you can look at and learn to read is price action itself, right? And the same goes for when we're looking at oil and natural gas. We can see the kind of bearish patterns here, the fail on the wedge that oil had and the continued lower highs and lower lows. And we can see as well that in asset markets, we are moving higher here. And take a look no further than it plays like Apple. Now, I'm not saying to just go absolutely all in on Apple here or anything. That's not my point, right? My point here is when we look at this chart and you look at the past few weeks, what have we seen continuously here? Well, obviously price is moving higher, but the vast majority of the trading days are green here. And anytime we get a combination of red days or one or two red days, usually buyers start coming in and they take advantage of the discount here. We can see back here during the relief rally in March, practically an entire month, almost an entire month of straight green candles. Price is trending higher here. It's not about catching the absolute best entry. And it's not a total pain if you buy something 3 or 5% more expensive. Because so long as you're getting your ticket for the ride, you get to ride along and you're going to benefit from it, right? So long as that trend is intact, hey, look, whether you make 7% gains or 10% gains, hey, it's a gain, right? And this is the key point here about relief rallies, to take advantage of them when they start to play out. Don't be in denial. Don't be so caught up in the long-term trend, even if you're like us who believe that we will get a revisit back down near the lows, right? I mean, we talk a lot deeper about this and some of the historical metrics as to why we're so confident in this in the Dash report that we just put out. But essentially speaking, we think that Apple, at a minimum, will probably come up to this range here around $175. And here's the ironic thing about this. People are going to, I know, laugh at this and stuff. There's the infamous, it could go up or it could go down statement here. But here's where it's really cool. Whether or not I'm right about there being a relief rally or not in the market, if this is actually perhaps even going to be the start of a new bull market, right? Maybe I'm completely too pessimistic here, right? The cool thing about this is that we know price is trending and it's likely going to come up to these ranges of the past. And price will likely do one of two things. Either it will be able to hold up here and spring higher, and that would be great. That might be indicative that the fact is that the Fed has had control here. These companies are going to be okay. Consumer confidence will return. Who knows? That might be the case. But either way, even if we come up here and we face resistance, or we come up and we're not able to make a support and we have that breakdown, that's the point where you sell. That's where you get out of the market. Same goes here for resistance here down below this range here, right? We would get out essentially if price starts to roll over here. And that's the beauty here of relief rallies. So long as you can keep on top of your positions and you can keep discipline, you can still be bearish long term, but you can ride both waves of the roller coaster essentially. I'm not saying you have to do that here. Not everyone is born to trade, and that's completely fine. If you know that that's not you, so be it. All I'm saying is for some of you who have been in those long-term positions and who didn't sell during this fearful period, it is much better to exit your position in some of these equities or cryptos, especially if you can get something that was where it was back during the peak of the bull market, versus down here during a period where you are going to panic sell and take a huge set of losses. That is the raging point I want to bring here, guys, where I can't express it enough here. I know a lot of people say, no, but I'm in it for the next 2 or 3 years. I'm in it for the long term. But if you've been able to see your positions double or potentially move 150% off the lows, I gotta advise you guys, like, again, I can't give you guys financial advice, but if you want to know what I'm doing, I'm taking advantage of that and I'm waiting for lower entries because I'll not only be able to likely boost my position size, but on top of that, this is a period of time where you go to cash and you protect yourself. There is not much dollar liquidity in the world to support a major expansive run-up. The Fed can engage in quantitative tightening, quantitative easing, and all this stuff that usually would push asset prices higher. We have to be protective of our capital. Plain and simple. And that's it for today's Macro Monday, guys. If you enjoyed this video, consider dropping a like, consider subscribing. If you haven't already, definitely consider subscribing to the Dash report down below in the description. It's a great way to support the channel. If you like my rambling here on the channel, perhaps you like my rambling in a written format, so you don't have to hear my voice all the time. I don't know, maybe you'll read it in my voice. Either way, guys, that's it for today's video. I hope you have a wonderful start to your month. Enjoy the day, make the most of it, and until the next one, I'll see you all in the next video. Take care, everyone.